Question 1. An applicant for a life insurance policy pays the initial premium and receives a conditional receipt. If the applicant dies before the policy is issued but while the insurer is still underwriting the application, what is the status of the coverage? A. Coverage is effective immediately from the date of application, regardless of insurability. B. Coverage is effective only if the insurer would have approved the policy as applied for. C. No coverage exists because the policy was not yet issued and delivered. D. The premium paid will be refunded to the applicant's estate, but no death benefit will be paid. Answer: B. Coverage is effective only if the insurer would have approved the policy as applied for. A conditional receipt provides coverage effective from the date of application or medical exam, whichever is later, but only if the applicant proves to be insurable according to the insurer's underwriting standards. This means if the applicant passes away before the policy is issued, the death benefit would be paid as long as the underwriting process would have resulted in policy approval. This protects the applicant by offering interim coverage while the insurer evaluates the risk. Remember, a conditional receipt doesn't guarantee coverage, it makes it conditional upon insurability. Question 2. All of the following are characteristics of a participating life insurance policy except: A. Policy owners may receive dividends. B. It is issued by a mutual insurance company. C. Dividends are guaranteed and taxable. D. Policy owners share in the company's surplus. Answer: C. Dividends are guaranteed and taxable. Dividends paid on participating policies are never guaranteed, they are a return of unneeded premium and depend on the insurer's financial performance. Also, these dividends are generally not taxable because they are considered a return of an overpayment of premium, not income. Participating policies are typically issued by mutual companies, allowing policy owners to share in the company's profits through dividends, which are paid out of the insurer's surplus. Think of dividends as a refund rather than profit, which is why they are not guaranteed and usually tax-free. Question 3. What is the primary purpose of the incontestability clause in a life insurance policy? A. To prevent the policy from lapsing due to non-payment of premiums. B. To ensure the insurer cannot deny a claim after a certain period, usually 2 years, due to misrepresentations by the insured. C. To allow the policy owner to make changes to the policy's beneficiaries at any time. D. To guarantee that the policy's cash value will grow at a fixed rate. Answer: B. To ensure the insurer cannot deny a claim after a certain period, usually 2 years, due to misrepresentations by the insured. The incontestability clause states that after a policy has been in force for a specific period, typically 2 years from its issue date, the insurer cannot dispute the validity of the policy due to misstatements or concealment in the application. This protects the beneficiaries, ensuring that claims are paid even if minor errors or innocent misrepresentations were made during the application process, as long as the 2-year period has passed. It helps provide certainty and security for the policy owner that the death benefit will be paid. Question 4. Which of the following statements regarding the free look period in California life insurance policies is correct? A. The free look period is 10 days, allowing the policy owner to return the policy for a full refund. B. The free look period is 20 days for policies sold to seniors, allowing for a full refund. C. The free look period applies only to term life insurance policies. D. The free look period starts from the date the application is signed. Answer: B. The free look period is 20 days for policies sold to seniors, allowing for a full refund. In California, the standard free look period for life insurance is 10 days, but for policies sold to individuals aged 60 or older, often referred to as seniors, the free look period is extended to 30 days, not 20. This period allows the policy owner to review the policy and return it for a full refund if they are not satisfied for any reason. The free look period begins when the policy is delivered, not when the application is signed, providing a window to fully assess the contract. This consumer protection ensures buyers have ample time to review the complex details of their new policy. Question 5. Which type of life insurance policy offers flexible premiums and an adjustable death benefit, along with a cash value account that earns interest? A. Term life. B. Whole life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is known for its flexibility, allowing policy owners to adjust premium payments, within limits, and the death benefit amount to suit their changing needs. It also builds cash value that earns interest, often at a declared rate, which can be accessed through withdrawals or loans. In contrast, term life offers no cash value, whole life has fixed premiums and a guaranteed cash value, and variable life's cash value fluctuates based on investment performance. Universal life provides a blend of permanence and adaptability, making it a popular choice for those seeking flexible coverage. Question 6. A life insurance policy's grace period typically allows coverage to remain in force for how long after a missed premium payment? A. 7 days. B. 15 days. C. 30 or 31 days. D. 90 days. Answer: C. 30 or 31 days. The grace period is a mandatory provision in life insurance policies that provides a specific timeframe, typically 30 or 31 days after the premium due date, during which the policy remains in force even if the premium is not paid. If the insured dies during this period, the death benefit will still be paid, minus the overdue premium. This clause protects policy owners from accidental policy lapse due to a slight delay in payment. It's a crucial safety net to ensure continuous coverage. Question 7. What is the primary difference between a revocable and an irrevocable beneficiary in a life insurance policy? A. A revocable beneficiary can receive cash value loans, while an irrevocable beneficiary cannot. B. A revocable beneficiary can be changed by the policy owner at any time without consent, whereas an irrevocable beneficiary cannot be changed without their consent. C. A revocable beneficiary receives a lump sum payment, while an irrevocable beneficiary receives payments over time. D. An irrevocable beneficiary must be a family member, while a revocable beneficiary can be anyone. Answer: B. A revocable beneficiary can be changed by the policy owner at any time without consent, whereas an irrevocable beneficiary cannot be changed without their consent. The key distinction between these beneficiary designations lies in the policy owner's control over changing them. A revocable beneficiary's designation can be altered by the policy owner at any time without requiring the beneficiary's permission. Conversely, an irrevocable beneficiary's designation cannot be changed without their written consent, giving them a vested interest in the policy. Understanding this difference is vital for policy owners to ensure their wishes for the death benefit distribution are upheld. Question 8. Under what circumstances can a life insurance policy be reinstated after it has lapsed? A. At any time, provided all past premiums are paid. B. Within a specified period, e.g., 3 to 5 years, by paying back premiums with interest and proving insurability. C. Only if the policy had a cash value at the time of lapse. D. Never. Once a policy lapses, it cannot be brought back into force. Answer: B. Within a specified period, e.g., 3 to 5 years, by paying back premiums with interest and proving insurability. A lapsed life insurance policy can often be reinstated, typically within 3 to 5 years from the lapse date, by fulfilling specific conditions. These conditions usually include paying all overdue premiums, often with interest, and providing evidence of continued insurability, such as undergoing a medical exam. Reinstatement is beneficial because it restores the original policy, preserving its original issue age and potentially better rates than a new policy. It's a second chance for policyholders to regain their coverage without starting over. Question 9. Which of the following best describes the insurable interest requirement in life insurance? A. The beneficiary must have a financial or emotional interest in the continued life of the insured. B. the policy owner must expect to suffer a financial loss if the insured dies. C. The insured must be capable of understanding the terms of the policy. D. The insurer must have a diverse portfolio of investments to cover potential claims. Answer: B. The policy owner must expect to suffer a financial loss if the insured dies. Insurable interest means that the policy owner, the person applying for and owning the policy, must stand to lose financially if the insured person dies. This interest must exist at the time the policy is purchased, but not necessarily at the time of death. For instance, a spouse has an insurable interest in their partner, or a business might have an insurable interest in a key employee. This requirement prevents people from taking out policies on others purely for speculative gain, upholding the principle of indemnity. Question 10. What is the purpose of the entire contract provision in a life insurance policy? A. It allows the insurer to amend the policy terms at any time with proper notice. B. It states that the policy document, application, and any attached riders constitute the complete agreement between the policy owner and the insurer. C. It requires the policy owner to read and understand the entire policy before signing. D. It specifies that the policy's cash value is guaranteed for the life of the insured. Answer: B. It states that the policy document, application, and any attached riders constitute the complete agreement between the policy owner and the insurer. The entire contract provision is a crucial clause that stipulates the policy document itself, along with the application and any attached riders, forms the complete and exclusive agreement between the insurer and the policy owner. This means nothing outside these documents can be used to alter or interpret the contract, protecting both parties by ensuring all terms are clearly defined within the written policy. It prevents either party from referring to outside agreements or statements to dispute the policy's terms later. Question 11. A life insurance policy loan taken against the cash value will A. Increase the death benefit payable upon the insured's death. B. Not affect the death benefit, but will accrue interest annually. C. Reduce the death benefit if not repaid before the insured's death. D. Be repaid only through surrendering the policy. Answer: C. Reduce the death benefit if not repaid before the insured's death. When a policy owner takes a loan against the cash value of a permanent life insurance policy, the loan amount, plus any accrued interest, will be subtracted from the death benefit if the insured dies before the loan is fully repaid. This means that while loans are generally available and do not require repayment during the insured's lifetime, any outstanding balance will reduce the payout to the beneficiaries. Policy loans are essentially borrowing your own cash value, using the policy as collateral. Question 12. Which of the following statements regarding the taxation of life insurance death benefits in California is generally correct? A. Death benefits are always taxable as ordinary income. B. Death benefits paid to a beneficiary are generally received income tax-free. C. Death benefits are subject to federal income tax but exempt from state income tax. D. Death benefits are tax-free only if they are paid in installments. Answer: B. Death benefits paid to a beneficiary are generally received income tax-free. One of the most significant tax advantages of life insurance is that the death benefit paid to a designated beneficiary is generally received income tax-free at both the federal and state levels. This means the full face amount of the policy is typically passed on to the heirs without income tax implications, providing a substantial financial resource. While estate taxes might apply to very large estates, the income tax exemption on the death benefit itself is a fundamental benefit. Question 13. What is twisting in the context of life insurance? A. Misrepresenting policy terms to induce a policy owner to lapse or surrender an existing policy for a new one with the same insurer. B. Misrepresenting policy terms to induce a policy owner to lapse or surrender an existing policy for a new one, to the detriment of the policy owner. C. Offering a rebate of premiums as an inducement to purchase a new policy. D. Failing to inform a client about all available policy riders. Answer: B. Misrepresenting policy terms to induce a policy owner to lapse or surrender an existing policy for a new one, to the detriment of the policy owner. Twisting is an illegal and unethical practice where an agent misrepresents or makes incomplete comparisons of an existing life insurance policy to persuade a policy owner to surrender or lapse their current policy and purchase a new one. The key element is that this action is detrimental to the policy owner, often resulting in higher premiums, new waiting periods, or loss of established cash value. This practice is specifically prohibited by the California Insurance Code to protect consumers from harmful policy replacements. Question 14. An agent's license in California is considered inactive if A. The agent has not sold any policies for 12 consecutive months. B. The agent has not completed continuing education requirements. C. The agent has not appointed with an insurer. D. The agent has moved out of state. Answer: C. The agent has not appointed with an insurer. In California, an insurance agent's license is considered inactive if they are not appointed by an admitted insurer. While an agent can hold an active license, they cannot transact insurance business or receive commissions until they are appointed by an insurer. Continuing education requirements and sales activity are important for maintaining the license, but the appointment is what enables the agent to actively sell and represent an insurer. It's important to be both licensed and appointed to legally sell insurance. Question 15. The payor benefit rider in a juvenile life insurance policy states that if the payor, typically a parent, dies or becomes disabled, the premiums will be waived until A. The insured child reaches a specified age, usually 18 or 21. B. The policy's cash value is fully exhausted. C. The insured child completes their education. D. The payor's spouse takes over premium payments. Answer: A. The insured child reaches a specified age, usually 18 or 21. The payor benefit rider is specifically designed for juvenile life insurance policies. It provides that if the individual responsible for paying the premiums, the payor, becomes totally disabled or dies before the insured child reaches a certain age, typically 18 or 21, the premiums on the child's policy will be waived. This ensures the policy remains in force and continues to build cash value, even if the premium payer can no longer make payments. It's a valuable protection for families with minor children insured by permanent life policies. Question 16. What is the primary purpose of the guaranteed insurability rider in a life insurance policy? A. It guarantees the policy will never lapse due to non-payment. B. It allows the policy owner to purchase additional coverage at specified future dates without proving insurability. C. It guarantees a minimum interest rate on the policy's cash value. D. It ensures the policy's death benefit will increase annually. Answer: B. It allows the policy owner to purchase additional coverage at specified future dates without proving insurability. The guaranteed insurability rider gives the policy owner the option to purchase additional amounts of life insurance coverage at predetermined future dates or specific life events, like marriage or birth of a child, without having to prove insurability or undergo a new medical examination. This rider is particularly valuable for younger policy owners who anticipate needing more coverage as their financial responsibilities grow. It ensures they can expand their protection regardless of any future health changes, securing coverage at standard rates. Question 17. Which of the following best describes the concept of replacement in life insurance? A. An agent helping a client choose between two policies from the same insurer. B. A transaction in which new life insurance or an annuity is purchased and, in connection with the purchase, an existing policy is lapsed, surrendered, or otherwise terminated. C. An insurer replacing one of its own agents. D. A policy owner converting their term life insurance into a whole life policy. Answer: B. A transaction in which new life insurance or an annuity is purchased and, in connection with the purchase, an existing policy is lapsed, surrendered, or otherwise terminated. In life insurance, Replacement refers to a transaction where a new policy or annuity is purchased, and an existing policy is terminated, lapsed, converted, or used to fund the new policy. This process triggers specific regulatory requirements in California, such as requiring agents to provide replacement notices and compare the existing policy with the new one. The purpose of these regulations is to protect consumers from being disadvantaged by replacing a policy without fully understanding the consequences, such as new waiting periods or higher premiums for the same coverage. Question 18. The suicide clause in a life insurance policy typically states that if the insured commits suicide within a specific period, usually 2 years, from the policy's issue date. A. The full death benefit will be paid. B. No benefits will be paid, and the policy will be voided. C. Only the premiums paid will be refunded to the beneficiary. D. The cash value, if any, will be paid to the beneficiary. Answer: C. Only the premiums paid will be refunded to the beneficiary. The suicide clause is a standard provision found in most life insurance policies that addresses claims related to suicide. If the insured dies by suicide within the first 2 years of the policy's issuance, the insurer typically only returns the premiums paid, rather than paying out the full death benefit. After this 2-year period, the full death benefit would generally be paid regardless of the cause of death, including suicide. This clause is designed to prevent individuals from purchasing a policy with the intent of committing suicide shortly thereafter. Question 19. What is the primary function of an admitted insurance company in California? A. It means the company is licensed to sell insurance in California and is subject to the state's regulations, including participation in the state's guarantee association. B. It means the company primarily sells insurance through online channels. C. It means the company can only sell to specific groups or associations. D. It means the company is headquartered in California. Answer: A. It means the company is licensed to sell insurance in California and is subject to the state's regulations, including participation in the state's guarantee association. An admitted insurance company is an insurer that has been granted a certificate of authority by the California Department of Insurance, CDI, to transact insurance business in the state. Being admitted means the company is subject to California's insurance laws and regulations, and its policyholders are protected by the California Life and Health Insurance Guarantee Association, CLIGA, in case the insurer becomes insolvent. This status provides a layer of consumer protection and regulatory oversight, ensuring the company meets solvency and conduct standards. Question 20. Which of the following factors is not typically used in calculating life insurance premiums? A. Mortality. B. Interest. C. Expenses. D. Policy owner's net worth. Answer: D. Policy owner's net worth. Life insurance premiums are primarily calculated based on 3 core factors: mortality, the likelihood of death at various ages; interest, the earnings the insurer expects to make on invested premiums; and expenses, the insurer's operating costs. The policy owner's net worth or income level is not a direct factor in determining the premium rate for a specific policy. Instead, it might influence the amount of coverage they can afford or are approved for. Understanding these factors helps agents explain how premiums are determined. Question 21. All of the following are typically included in a life insurance policy's general provisions section, except A. Policy owner's rights. B. Dividend options. C. Riders and endorsements. D. Illustrations of future cash values and benefits. Answer: D. Illustrations of future cash values and benefits. While illustrations of future cash values and benefits are provided to a prospective policy owner during the sales process and often accompany the policy, they are not typically included within the actual, general provisions section of the policy contract itself. The general provisions usually detail the contractual rights and responsibilities, such as policy owner's rights, e.g., assignment, loans, dividend options, for participating policies, and a list of any attached riders or endorsements. Illustrations are projections, not contractual guarantees within the policy language. Question 22. What is the main difference between term life and whole life insurance? A. Term life has a cash value, while whole life does not. B. Term life offers coverage for a specific period, while whole life offers coverage for the insured's entire life. C. Term life has adjustable premiums, while whole life has fixed premiums. D. Term life death benefits are taxable, while whole life death benefits are not. Answer: B. Term life offers coverage for a specific period, while whole life offers coverage for the insured's entire life. The fundamental difference between term life and whole life insurance lies in the duration of coverage. Term life insurance provides coverage for a specific period, or term, after which coverage ends unless renewed. Whole life insurance, a type of permanent insurance, provides coverage for the insured's entire lifetime, as long as premiums are paid. Term life does not typically build cash value, while whole life does, and whole life usually has fixed premiums, unlike some flexible premium permanent policies. Question 23. An agent receives a notice of an adverse underwriting decision from an insurer regarding a client's application. What must the insurer also provide the applicant? A. The specific reason for the adverse decision. B. The name and address of the reporting agency, e.g., consumer reporting agency, that provided information leading to the decision. C. Information on how the applicant can obtain a copy of the report used. D. All of the above. Answer: D. All of the above. When an insurer makes an adverse underwriting decision, e.g., denying coverage, charging a higher premium, based on information from a consumer reporting agency, the insurer is required to provide the applicant with the specific reason for the decision, the name and address of the reporting agency that supplied the information, and information on how the applicant can obtain a free copy of that report. This consumer protection ensures transparency and allows applicants to verify the accuracy of the information used in underwriting. Question 24. A waiver of premium rider in a life insurance policy is designed to A. Allow the policy owner to skip premium payments for a year without penalty. B. Waive future premium payments if the insured becomes totally disabled. C. Reduce the annual premium amount after a certain number of years. D. Waive the requirement for a medical exam at the time of policy application. Answer: B. Waive future premium payments if the insured becomes totally disabled. The waiver of premium rider is a valuable feature that ensures continued life insurance coverage even if the policy owner or insured, if different, becomes totally disabled and unable to work. If the qualifying disability occurs, the insurer will waive all future premium payments for the duration of the disability, keeping the policy in force without further cost to the policy owner. This rider provides significant financial protection by preventing the policy from lapsing during a period of financial hardship due to disability. Question 25. Which of the following is an example of an unfair trade practice known as rebating in California? A. An agent falsely claiming to be from the Department of Insurance. B. An agent offering a prospective client a portion of their commission as an inducement to purchase a policy. C. An insurer refusing to pay a legitimate claim without a valid reason. D. An agent recommending a policy that is clearly unsuitable for the client's needs. Answer: B. An agent offering a prospective client a portion of their commission as an inducement to purchase a policy. Rebating is an illegal practice where an agent offers a prospective client anything of value not specified in the policy, such as a portion of their commission or a gift, as an inducement to purchase an insurance policy. This practice is prohibited in California because it can lead to unfair discrimination among policyholders and disrupt the market. The premium stated in the policy is the only lawful consideration for the insurance.